Beating the market is a phrase often associated with achieving investment returns that outperform standard benchmarks like the S&P 500. For decades, this has been the holy grail for investors, both individual and institutional. While it's a challenge that eludes many, advanced investment strategies can help ambitious investors tilt the odds in their favor. Below, we explore the key strategies, real-world examples, and actionable tips that make beating the market a tangible goal. 1. Embrace the power of contrarian investing. Contrarian investing means going against the crowd. While the masses flock toward popular stocks during a bull market, a contrarian seeks undervalued assets that others overlook. This approach often leads to buying low and selling high. Fact: legendary investor Warren Buffett epitomizes contrarian thinking. His famous quote, "Be fearful when others are greedy, and greedy when others are fearful," highlights the essence of this strategy. For instance, during the 2008 financial crisis, Buffett invested in undervalued companies like Goldman Sachs, yielding substantial returns when the market rebounded. 2. Harness the magic of dollar cost averaging, DCA. Dollar cost averaging involves investing a fixed amount of money regularly, regardless of market conditions. This strategy minimizes the risk of poor timing and helps accumulate more shares when prices are low. Real-life insight: over the last decade, consistent DCA into index funds has helped countless investors amass wealth despite market volatility. The key here is discipline and patience, two vital traits for long-term success. 3. Diversification. The ultimate safety net. Diversification reduces risk by spreading investments across various asset classes, industries, and geographic regions. By owning a mix of stocks, bonds, real estate, and alternative investments, you're less likely to experience severe losses during downturns in specific sectors. Interesting fact: studies show that a well-diversified portfolio can reduce risk by up to 60% compared to concentrated portfolios. Diversification also includes thinking globally. Emerging markets, for example, offer higher growth potential compared to developed economies. 4. Utilize factor investing. Factor investing involves targeting specific drivers of returns, such as value, size, momentum, and quality. These factors have been statistically proven to outperform broader markets over time. Case study: value stocks, companies trading at lower price-to-earnings ratios, have historically delivered higher long-term returns. During the tech bubble burst in the early 2000s, value investors who focused on underpriced companies saw their portfolios thrive. 5. Leverage technology and data analytics. The rise of fintech has made advanced data analytics accessible to retail investors. Tools like AI-driven platforms can analyze market trends, predict price movements, and optimize investment strategies. Example: quantitative trading firms use algorithms to identify patterns and inefficiencies in the market, capitalizing on opportunities that human traders might miss. While individual investors may not have access to such high-level tools, platforms like Wealthfront and Betterment offer algorithmic assistance tailored for beginners. 6. Stay ahead with research and education. The market rewards those who stay informed. Reading annual reports, following financial news, and understanding economic trends can provide an edge. Investors like Peter Lynch advocated for investing in what you know, combining everyday knowledge with thorough research. Motivational note: Lynch's strategy of buying what you know enabled him to turn the Magellan Fund into one of the most successful mutual funds in history. 7. The psychology of patience and discipline. Perhaps the most underrated strategy is mastering your emotions. Fear and greed are the market's biggest enemies. Advanced investors develop the emotional fortitude to hold their investments during downturns and avoid overtrading during booms. Fascinating insight: behavioral finance studies reveal that emotional investors often underperform the market by as much as 4% annually due to impulsive decisions. Conclusion: combining strategies for maximum impact. No single strategy guarantees success. The real magic lies in combining these advanced approaches to create a personalized investment plan. Diversify wisely, harness the power of data, stay disciplined, and dare to think differently. With these strategies in place, beating the market becomes more than just a dream. It becomes a calculated possibility.